How fraudsters create fake people to steal millions. Hello everyone. Welcome back to the Inner Mind. Imagine walking into a bank, applying for a credit card, getting approved, building a perfect payment history, and earning the bank's trust. Everything looks normal. Everything looks safe. Everything looks real. Except for one thing. That customer doesn't actually exist. Today, I'll show you how fraudsters create fake people and use them to steal millions from banks. And by the end of this video, you'll understand how synthetic identities are created, why banks struggle to detect them, how fraudsters build trust for months, and how fraud analysts eventually uncover them. This fraud has a name: synthetic identity fraud. And unlike traditional fraud, where someone steals an identity, synthetic fraud creates an entirely new person, a person who never existed. And that's exactly why banks struggle to catch it. Because there is no obvious victim, no stolen card, no hacked account, no dramatic breach, just a customer that shouldn't exist. Let's first understand what a synthetic identity actually is. Think of identity as a puzzle. A fraudster may take a real PAN number, a different mobile number, a fake address, a newly created email account, and combine them together. The result? A person who never existed. Not completely real, not completely fake. Something in between. A synthetic identity. And that makes detection extremely difficult. Now here's where things get interesting. Most fraudsters are impatient. They steal. They spend. They disappear. Synthetic fraudsters are different. They're patient. Very patient. Instead of stealing money immediately, they spend months building trust. Sometimes 6 months. Sometimes 1 year. Sometimes even longer. And that patience is what makes this fraud so dangerous. Let's say the fraudster creates a synthetic identity today. The first application gets rejected. No problem. A few weeks later they apply again. Maybe for a small credit product, a low-limit card, a buy now pay later account. This time they get approved. Now they start making small purchases. Every payment is made on time. Month after month. The credit profile slowly becomes stronger. The risk score improves. The bank sees a responsible customer. The fraudster sees an opportunity. And then comes the most important stage. The bank starts trusting the customer. Credit limit increases. New offers arrive. Personal loans become available. Premium cards become available. Everything appears perfect. Because the fraudster planned this from the beginning. This stage is known as the build phase. And many fraud analysts never see any obvious red flags during this period. Quick question. Before watching this video, had you ever heard of synthetic identity fraud? Let me know in the comments. And if you're enjoying this fraud analytics series, consider subscribing. Let's get back to topic. Suddenly, everything changes. The fraudster uses the entire credit limit. Every available product gets utilized. Multiple transactions happen. Loans are drawn. Balances increase rapidly. And then, the customer disappears. No repayments. No contact. No recovery. This is called a bust-out fraud. Months of trust building. 1 week of exploitation. And potentially millions in losses. Now you might be wondering, if this fraud is so dangerous, how do banks catch it? The answer is patterns. Not individual transactions. Patterns. Fraud analysts look for signals such as multiple applications from the same device, shared phone numbers, shared addresses, unusual application velocity, thin credit histories, and hidden connections between accounts. One signal alone means nothing. But when multiple signals appear together, the risk becomes visible. This exact strategy has been used by organized fraud rings across the world. Investigators have documented cases where synthetic identities were built over long periods. Credit histories were established, and lenders were exposed to large financial losses when the fraudsters eventually disappeared. That's why synthetic identity fraud is now considered one of the fastest growing fraud threats globally. The biggest lesson here is simple. Fraudsters don't always steal identities. Sometimes, they create new ones. And that's exactly what makes synthetic identity fraud so dangerous. In the next video, we look at something even more frightening. Instead of creating a fake person, the fraudster becomes you. We'll break down account takeover fraud and how criminals gain access to genuine customer accounts. Trust me, you don't want to miss that one. If you found this video useful, give it a like. Share it with someone interested in banking, fraud analytics, or risk management. And subscribe to The Inner Mind for more practical content on fraud, risk, banking, and financial technology. I'll see you in the next one.